Hello, fellow RoboCapitalists. Hope you're well. So I saw the ADP numbers come out this morning, and I was like, whoa, we got to do a video on this for sure. If you didn't see the news, another negative number. So let's get right into the details over on CNBC. And then I'm going to tell you guys the trade I just put on. I just put this trade on in my own personal portfolio, not paper trading, real money. I'll let you guys know what I did as a result of this ADP data that just came out. Okay, so let's shoot over to CNBC. Let me do a screen share. Forgot to do that. All righty then. Ready to rock and roll. Here we go. November private payrolls unexpectedly. Was it really? See, this is what's weird. Is it really unexpected? Because we were getting the weekly numbers when we had the government shutdown. I did a few videos on this, so I don't know if you guys saw that. But ADP was coming out with weekly data just to kind of say, hey, we know you're not getting the non-farm, so here's some extras. I think that's what happened. I don't think they usually do weekly data. And the numbers were terrible. The numbers were all negative. So I don't know why it's unexpected, but it is true. If you look at the trusty Market Watch calendar, the market was expecting a positive 40,000, And the last report that we received, this was 47,000. And today we come in at a negative 32,000. Negative 32,000. We're also going to go check out what interest rates are doing. But key talking points: U.S. labor market slowdown intensified in November as private companies cut 32,000 workers, with small businesses hit the hardest. No surprise there. Larger businesses, entailing companies 50 more employees, actually reported a net gain. However, establishments with fewer, I think that's kind of not just about the small and mid-sized, bigger business, but also about the industry that usually makes up the majority of the small businesses. And I would assume those are industries or niches, let's say, that focus on kind of the middle class. The ADP report is the last monthly jobs picture from the Federal Reserve, or last monthly jobs picture the Fed will get before the meeting December 9th to the 10th. Oh, you know what we need to do is go to the CME. I did not think about this. Let's shoot over there, then we'll go back to the CNBC article. So, whoa, that's not good. That guy looks pissed off. He says, we don't have any data. Wah, wah, wah. Let's see if we can refresh. There we go. So did we get a bump today based on ADP? Slightly. So yesterday, the odds of a rate cut were 88%. Today, they go up to 89%. So I think the market is basically saying, it's ADP. The Fed doesn't put as much focus on that as they do the non-farm payroll. And we're already close to 90%. So maybe that's what's going on here. But let's get back to CNBC. Okay, slowdown intensified. We get that. However, establishment fewer than 50 workers saw a decline of 120,000 jobs. So the small businesses that I think would most cater to the poor and middle class, declining 120,000, including a drop of 74,000 among firms with 20 to 49. The total loss was the biggest drop since March of 2023. That's not good. Education and health services led gainer, 33,000 hires. Here we go. Leisure hospitality added 13,000. But a broad-based decline across industries drove the total lower. The biggest loss came from professional business services, a decline of 26,000. Information services, minus 20. Manufacturing, because tariffs work so well, negative 18,000. Sorry, had to. The rate of pay also slowed, with workers staying in their jobs, seeing a 4.4% year-over-year increase. It's just, it goes back to this, right? You guys that watch the channel all the time, you know exactly what I'm talking about. Prices do this, Wages do this, you get the delta, and that decreases disposable income. And eventually, the businesses, like the small businesses, just wave the white flag and say, we don't have a choice. We got to start firing workers. Okay, ADP's chief economist, Nella Richardson, guessing that's a gal, she says hiring has been choppy of late as employers weather cautious consumer and uncertain macroeconomic environment. Yeah, I mean, I agree. Jeff talks about this all the time, my good buddy Jeff Snyder. And he's like, is it really uncertain? Seems like it's pretty certain. when you look at the data we're actually getting from the labor market, I mean, non-farm payrolls, we've already had 2 negative reports this year. I look at the yield curve. The 10-year treasury is trading just about Fed funds. I mean, is that uncertainty? Seems like it's pretty certain what the market is telling you as far as the underlying economy. Now, we're not talking about the stock market. A lot of people say, oh, no, the stock market's at all-time highs. Okay, great. But unfortunately, the stock market really doesn't reflect what's going on in the real economy. You guys know that well. In fact, a lot of times the stock market can have an inverse relationship to what's happening in the economy. Let's get back to the article. The ADP report is the last jobs. Okay, we talked about that. In recent week, Fed policy makers have expressed a divergence of opinion. Yeah, like a month ago, they're all hawkish. Remember Powell came out in his press conference and was like, oh, I don't know about the rate cut in December. It's not guaranteed. And then you had a lot of the talking heads, or the Fed talking heads, kind of repeat this same, or take this same stance. And then more recently, over the last 2 weeks, you see pretty much every single Fed governor come out and say, well, maybe we're a little more dovish. So they say the Bureau of Labor Statistics will release its take on the non-farm payroll picture December 16th. And that is delayed because of the shutdown. And just as a reminder, that is after the Fed is going to come out with their policy decision. Now, I've got a take on this. Basically, the way I look at it is, if you just look at the market data, you look at the CME expectations, you got to assume they're going to cut 25 basis points. My argument against that would be, well, we got to see with PCE, right? If PCE is, I think it's all about PCE. So let me show you what I'm talking about, guys. Here is the report that will come out on Friday. So I think the Fed does pay quite a bit of attention to this as far as kind of trying to get a read for inflation. And so if it's quote unquote sticky, then I could see Powell leaning toward a pause. Why? Because this is basically his last hurrah. Obviously, Trump isn't going to hire him again. And I think he's out in March or April. And he still wants to go out looking like Paul Volcker. You know, that he was tough on inflation. He broke the back of inflation. He definitely doesn't want to go out like Arthur Burns. So, you know, at the end of the day, we like to think that these things are just based on models and quantifiable numbers, you know, everything that's outside of just human emotion. But at the end of the day, I think that plays a big part in everything we do. It plays a huge part in markets. And I think it does play a part in what's going on with the Federal Reserve and their interest rate decision. I think a lot of their interest rate decisions are political at times. So that would be my argument as to why we would get a pause. Is it's just Powell doesn't want to go out looking like Arthur Burns. He wants to go out looking like Paul Volcker. But this is going to be huge. This is going to be huge number here. Definitely going to do a video on that one. Might even do a live stream. Let's go down and look at the other data that came out today. We have import price index. That was down just slightly. Let's see here. We've got the industrial production. This is delayed. Okay. We've got the capacity utilization, a little lower. The PMI, a little lower. ISM services just slightly higher. And then we've got jobless claims tomorrow too. That will be important. So let's look at what's going on with interest rates. You guys know from watching my videos that if I had just 2 indicators to look at to set up my entire portfolio for the next 6 months, it would definitely be interest rates, the yield curve, and the labor data for sure. And remember, guys, here in a moment, I'm going to tell you the trade that I just put on. I don't think it got filled yet, but I'll go over it with you guys. And it was specifically because of the price action that I'm seeing in the bond market and this ADP payroll. So we've got the 2-year treasury just slightly down today, about a basis point. I would expect it would have been down further, but I guess it's already pricing in a Fed rate cut, the 2-year treasury. So the ADP numbers are kind of like, no big deal. We already priced it in. Now let's go to the 10-year treasury, which is down. I would have expected the 10-year to be down a little bit more because 2-year, the Fed really doesn't control interest rates. But if they do have an influence, they're going to have a much more of an influence at the front end of the curve, which would have more of an impact on the 2-year treasury than with the 10-year treasury. So I get it, the 2-year, but I would expect the 10-year to be a little bit lower than, I would have thought maybe 3 or 4 basis points. I know we're kind of splitting hairs here, but let's look at a chart of the 10-year treasury. I'm going to go year to date, and you see what's going on here. Pretty much down on the year for sure, but you see we're getting down to like 4%. It's kind of bouncing up, then going up, and it's just kind of bouncing around 4%. And then when you look at the TLT, you see that that's kind of been range bound as well. So for me, my base case is over the next 2 months, the probability is greater that the 10-year treasury will be lower than it is today. And I'm just using the 10-year treasury as a proxy for the TLT. Okay. And so that's my base case. So what I was able to do is I was able to go out and again, I did a limit order, so I don't know if it's been filled, but the idea is I was going to sell puts slightly below this range. So hopefully you guys can see this. See how it's kind of bouncing on 4%. And again, I'm just using it as a proxy for TLT. I actually sold puts on the TLT, not the 10-year treasury, to be super clear here. But I just went slightly under this line, and I'm like, yeah, I'll go ahead and sell puts there. And because my idea, well, actually, it's inverse of the TLT. Let's go to the TLT, guys, because I'm getting this completely backwards. because of the inverse relationship between yields and prices. That's just in case you didn't catch that. So here you go. So it's the same thing here, but with this, the TLT, it's the opposite. If yields go down, then what's going to happen is the price is going to go up. Okay. And if yields go up, then the price is going to go down. So this is the chart that I was basically referring to. So you see how we're kind of bouncing along here right around 88, 89, something like that. And today we are at 88. So we're up a little bit, 88 now 0.84. So what I did is I came over here and I said, okay, well, I'll sell some puts a little bit lower because my base case is the TLT increases in price. In other words, interest rates go lower on the long end of the curve over the next month or two. That would be my base case. So is it a certainty? No, I would say, what is my confidence level? 75%, 75%. But basically by putting on, I think they call it a put spread. So what I did is I sold puts at whatever, let's just say 88. And then I bought puts at 87 just to kind of cover my butt there. And so you're getting paid for that, right? Because you're pocketing the spread. And then what happens is if the TLT at expiration is trading higher or then you win, because then the puts are not exercised; they expire worthless, and you get the premium, the difference between the premium you paid and the premium that you got when you sold. So where you would lose is if the TLT is trading at, let's say, 85, which would mean interest rates would have to go up. It would have to go up substantially at the long end of the curve. And so again, I think the probability that they go down is 75%. So if I'm basically paid, it's like a 50-50 bet where the max I could lose, let's just say, is $10,000, and I'm being paid $10,000. And so I'm like, look, if I'm getting 50-50 odds, but I think there's a 75% chance that interest rates are going to be lower, therefore I win, or the TLT goes up, therefore I win. I'm going to take that bet all day long. So anyway, I just wanted to, because we talk about the macro stuff all the time on this channel, and I want to give you guys updates, and then on the whiteboards I want to explain it to you. But then I also want to give you guys, it's not investing advice, but I want to give you guys what I'm using to take action in my own portfolio, because I know a lot of times we talk about this stuff and it's a nice thought experiment, but it seems more theoretical. And my point here is it's not. It's absolutely not. This stuff, if you understand the monetary system well and what drives interest rates, it's all about growth and inflation and yada yada yada. This stuff that we talk about on this channel is very, very, very actionable. And the George Gammon, the channel with the whiteboard videos. So I just wanted to share that with you guys. We'll see if the order gets filled. And if you want more insider intel and more kind of contrarian strategies that I have been using all year to do extremely, extremely well in the portfolio, knock on wood, and strategies like this put spread, or whatever you want to call it. I talk about this all the time with the members of Rebel Capitalist Pro, and that's the investment community I have with Chris McIntosh, Brent Johnson, Patrick Srezna. And if you want to check that out, we'll put a link in the description below. All right, guys, on that bombshell, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism, and put that PCE release on your calendar. It's going to be super, super important. That's this Friday. We'll see you in the next video.